These are the physics-based sentiment forecasts for the U.S. stock market using data as of January 31st, 2025. Our forecasts call for long-term physics-based sentiment to remain moderately optimistic, which is one step below the most optimistic level. Short-term physics-based sentiment to be pessimistic over the next 3 weeks. There are no flashes of sentiment anticipated within this forecast horizon. Our forecast for U.S. stock market price momentum, as measured by the 14-week RSI, is for a decline in price momentum over the next 3 weeks. Implied economics-based sentiment now registers as meaningfully negative, which suggests that investors have a pessimistic view of economic and market. The lower panel shows the physics-based sentiment drivers, which show the natural shifts in investor optimism over the last 52 weeks and the next 3 weeks. Physics-based drivers explain a meaningful portion of stock market volatility, and we can forecast them several months in advance. The upper panel displays the price of an ETF tracking the S&P 500 equal-weighted index, shown as a dark blue line, alongside our measures of return acceleration, which we call the Market Resilience Indexes, or MRI. In early August 2024, the long-term driver shifted to its most optimistic stance, marking the start of a strong upward move in stock prices that lasted for several months. Then, in early December 2024, the long-term driver shifted to a less optimistic stance, coinciding with the end of that rally. This change also anticipated negative signals in technical measures like MACD. Since early December, market behavior has been consistent with the behavior indicated by the MRI in the upper panel. Over the past several weeks, the micro MRI completed the down leg of its cycle and transitioned to the up leg of its cycle. The long-term price trend of the stock market, as indicated by the macro MRI, measuring return acceleration, is negative, even as the physics-based long-term driver continues to suggest a moderately optimistic stance. The condition reinforces that investors have a negative view of economic and market conditions. It also warrants caution as we move into a period of naturally occurring investor pessimism, which is indicated to occur in early February by both the short-term physics-based driver, shown in Figure 2, and the predicted price momentum of the market, shown in Figure 3. The forecast of the market's price momentum is shown as the solid red line. It indicates a decline in price momentum in early February. It is important to keep in mind that this forecast is based only on physics-based drivers and not economic or market conditions or political shifts currently taking place. Recent actual market price momentum has been lower than expected. Condition is reflected in the smoothed excess RSI measure, which has shifted to a meaningfully low level the week of January 31st. We consider this smoothed excess RSI to be an effective indicator of economics-based sentiment. The current condition of this measure indicates investors have a pessimistic view of economic and market factors such as high stock valuations, tariffs, slower growth, and high interest rates. As we move into a period of naturally occurring investor pessimism in February, negative economics-based sentiment will likely amplify the market's negative reaction to bad economic news and events. Feel free to contact me with any questions or comments. Thank you for watching.